Hey guys, welcome to the Best Bitcoin Data Show, episode 6. If you just joined us, we are doing this every week at the same time, Tuesday noon Eastern time. And It's usually three of us. Today, Spinston cannot join, so it will be just me and Plan C. And we have a great set of charts for you that will talk about whether Bitcoin is overvalued or undervalued, or where are we in the valuation model. We're going to show you several models, including a quantile model, a volatility adjusted power law model, and an adjusted MVRV chart. On top of that, we will talk about Bitcoin's year-to-date performance and how the price action, and finally, an update to a very interesting chart by Plan C that basically analyzes the short-term holder behavior, because they are very important for setting the short-term behavior of Bitcoin. If you want to analyze where are the likely places where the market will reverse, you got to understand short-term holders. Long-term holders essentially drive the overall cycle and fundamentals, but short-term holder behavior determines the shorter-term volatility. Okay, so with that, um, let's begin. How are you doing, Clancy?
Yeah, doing great, doing great. I mean, I'm sure a lot of people are feeling pretty good that have held Bitcoin a long time. We talked about the 8 months of consolidation kind of chop that we had in previous weeks, and it's paid off to wait it out here as expected. I mean, we're expecting a move up anytime, like we discussed. Bitcoin can essentially move up at any point, really, at this point in the cycle. And it's very comparable actually to 2020. In 2020, I remember around this time we started to kind of have a similar, grind move up, and we're getting close to an all-time high here. So currently we're sitting at 72 650, and the all-time high I think is roughly around 73 800, 73 750. So we're about 1,000 below the all-time high right now. So I mean, at any point we could easily, even on the show, put in an all-time high. Right, Bitcoin can move in quick bursts. So that's the thing we should also discuss. And we're going to go through quite a few things on the show here quickly. But it's just so risky during a bull market to be sitting on the sideline at any point. Like if you're a trader, I think trading is an extreme sport, especially with Bitcoin during a bull run. Like it's just so risky to be sitting on the sidelines thinking you can jump in and out of the market, because the majority of the gains are in a condensed period. So it's always best to be in if you're an investor. If you're a trader, that's a whole nother thing. I mean, if you really think you can outperform the market, you better have some ridiculous metrics that you're looking at and some serious analytical skills. But yeah, it's best just to be in, and right now, I mean, we're looking pretty good. We got some liquidations. My understanding is there's quite a few liquidations. I think somewhere around 73-ish. So yeah, what are your thoughts on the price action? So, we can show the chart, I guess, as well.
Yeah, well, pretty exciting. Like you said, you guys just go look at Bitcoin chart. You'll see the majority of the gains this earlier this year was not even when ETFs showed up. It was actually the run up towards approval of the ETFs. A lot of that, and then at the end of Q1, we reached all time high, but then that was it. All the time, all the way from that time to now, we've been just in a consolidation and a slow bleed period. It is only like, what is it, like a few weeks in the last couple of weeks that we are kind of breaking that pattern and going up. So it's always like this. Bitcoin is a massive jump, but then a long period of boring, depressing price action to kind of push the short-term thinkers and tourists out of the market. They're going to get frustrated and kind of try to do other things outside, and then Bitcoin, rips in a matter of a few days. That's what it is, and that's how it has always behaved. So it makes timing the market extremely risky. Okay, so this is the price action in the last 24 hours. We've got a beautiful 5% jump, and especially this move took us out of the prior pattern of consolidation. So it's very, very welcome. Yeah, I can make it bigger. Yeah, so just look at the numbers. Uh, in the last week, we've gone up by about 7%. In the last month, 8%. And here, that last one, this should be the last year, not year to date. But I have a more accurate set of numbers here for you. This is Bitcoin's performance year to date compared to all other major asset classes. So you can see Bitcoin has returned 63% starting from beginning of this year, which is fantastic, phenomenal. Then we have silver and gold. Gold has been doing great, but still at half the performance of Bitcoin. Congratulations to the gold bugs. They're making some money here. Then we have Nasdaq. It's very interesting that gold has been actually outperforming Nasdaq. That's kind of mind blowing. Then we have AI, S&P 22%, AI stocks 16%. Of course, this is combining everything. So if you look at an Nvidia or a few other ones, probably this thing will change significantly. I'm not exactly sure if Nvidia outperforms Bitcoin right now this year, but over time it has. So it's probably the only thing that might have outperformed it. But still, as a class, they aren't doing much better than the rest of the S&P. Dow Jones, real estate, bonds are of course horrible. Long bonds even worse. The long bond yield is going up. Valuation of those bonds are going down. So it's very bad time for bond holders and a wonderful time for Bitcoin holders. And I expect this chart to just be uh, following the, I mean, the market following the same pattern moving forward. We are in a period where we have extreme um, inflation, monetary inflation. Uh, there is significant debt that all the central banks, including the U.S. central bank, hold, and there is no way out of it. They are spending $1 trillion a year on interest expense, and their deficit is very high and increasing. There is no way out of this. When you spend more than what you bring, there is zero solutions that you have. Why? Because you cannot cut spending. Like Elon Musk wants to cut spending by $2 trillion. He can do some of it, but like as soon as it becomes meaningful, everyone is going to be objecting him, and he's going to get no support from anyone because this is like a tragedy of commons. Like when you created a system like this, every part, like every senator, every congressman, everyone has constituencies, and they just fight to create more spending that helps their constituency, and that's how they get votes, right? And if you look at the discussions of both parties, they're always like, I spent this much money to help the farmers. I spent this much money to help the poor. It's all about spending more money, right? So if you want to cut that spending, you're going to have extremely angry opposition from somewhere. Anything you touch, you're going to get significant opposition, and you don't get any consensus on touching on reducing the cost. So there's always consensus on spending more. There's zero consensus on spending less. So this is not going to happen. What's the other solution? Inflation, monetary, printing more money. Some people call this soft default on bonds, right? And that's exactly what's driving commodity prices higher. So I bet if you add commodities, this will also be very revealing. But the fact that gold is just ripping higher past all-time high, Bitcoin is almost at all-time high with $1,000 difference. This is all. This is gonna have. This is gonna continue with some volatility, of course, but this is going to be our lives and our pattern, the pattern of the market for the next 5 or 10 years. It will all be monetary expansion, and this will push stock market and everything else higher. But assets with the highest scarcity, with the lowest amount of supply elasticity, they will perform the best in this environment. And Bitcoin is just going to be that sponge that absorbs the maximum amount of liquidity that they have to inject into the system to move, right?
Yeah, it's interesting. Like you said there, like gold, silver, and Bitcoin kind of leading the charge, percentage wise. And with silver, I mean, it's just silver. My understanding with silver, I'm not an expert on silver, but there's a lot of demand for silver these days. So it's might have, like, compared to gold, it's it's relatively scarce as well. It's not as scarce as Bitcoin, of course, and neither is gold, but they're all somewhat scarce and they're all performing pretty well. So yeah, and then the rest of the commodities. I mean, those commodities, it's hard to know. That's a bucket, so it could be anything. But those are most likely not nearly as scarce commodities. So yeah, it's interesting to see kind of an overview, because even if people feel like, oh, Bitcoin's been not really doing a whole lot, for a while, you can see it's still outperforming basically everything. And like you said, the only thing is maybe Nvidia that's outperformed Bitcoin on certain time frames, but that's most likely going to change by the end of next year. Most likely, Bitcoin will be the best asset to be in, even better than Nvidia. So we'll see, but that's kind of what I think.
Yeah. All right. So then the question for us is, by the way, the commodity thing I have here is kind of combining everything. I would say, like, I need to add oil as a separate thing here, and maybe a few other iron probably, or copper would be important to add. But for now, yes, we are combining everything, and it's pretty low. Now, the next question we want to ask is whether, after all this increase in price, whether Bitcoin has entered the overvaluation stage or not, right? So this is what we're gonna spend some time going over some of the models that we've been developing and discussing previously. All those models have been kind of pointing to the fact that Bitcoin is severely undervalued and has a lot to gain, and some of that gain has happened. But does that change our analysis at all? So what I want to talk about is, like, first of all, you know that we are a fan of the power law model because it just statistically works better. And actually, I should say, it just works. Other models do not, and they're typically overfit games. Now, we still see that if we run an OLS regression with the power law, this white dashed line is still above where we are. But how exactly is that? The power law average value will tell us at this point in the cycle, the average value is at 79,000. The current value is at 70. Is it 72? Yeah, what I have on the chart is kind of the latest close that I've been able to collect. This is probably last night or something. So it puts it at 70. But at 72, we are kind of still below the average, but we're getting there, right? We've been saying that, like, here as well. The gap was increasing, and we will constantly warning people that if the gap between the kind of a fair value or average value and the current market value increases, there's going to be a higher chance that it will bounce back up in a very rapid fashion, and that's happening. And we were still below what the model would suggest for the average. And one of the ways you can kind of quantify this a little bit better is through volatility adjusted power law index that I've created. And this basically looks at, again, uses the last night's close. So today we've had crazy price action, of course. So up to last night, VPLI index was at 44. Today, with the price action, maybe it's at 46, 47, but it's still below 50. And on this metric, 50 indicates neutral valuation. Like, when we exactly get to the power law value, our index gets to 50. So we are still in the undervalued zone, but it's getting very close. So that's why it's labeled as neutral valuation. If you remember previously, we were in the cool zone. We were cool. Now we're getting closer to neutral. But this is all expected. We have to go through the neutral and then begin entering the hot zone and the bubble zone. That doesn't mean you will sell, right? That doesn't mean you're expecting a downturn or anything. This is a part of the natural progression of the Bitcoin cycle. Unless we get into, like, super high levels, like above 80 or something, I wouldn't even worry about.
Yeah, just because we say, just to be extremely clear for people following week to week with the show, just because we say Bitcoin's overvalued on any of these models does not mean well, first of all, we don't give any financial advice whatsoever on this show, right? It's all just education. But just because we say, Bitcoin's overvalued on a model does not mean we think that it's a good time to be selling your Bitcoin, right? It's we can be overvalued to a large extent. That's the way these models work. We go extremely undervalued throughout parts of the cycle, and then we get to extremely overvalued throughout parts of the cycle. So overvalued does not mean sell. That's just to be extremely clear.
Exactly. So we actually do expect a long period of overvaluation, like the last cycle here, and then when it reaches the unsustainable level, that's where you get worried. And again, at this point, I've been clear previously, you can change your strategy, but you can also just write it out if you're a hodler type. But it's good to know, at this point, the risk is going to be very high. Now, Plan C has made this beautiful model of power law probability model that uses the quantiles, right? So what should we learn? What do we learn from this one? It kind of adds to the previous chart.
Yeah, it's just a different way, like we've talked about. It's a different lens of looking at fair value through, right? Because this is looking at the median, whereas the last one was the average. So this one is specifically 50%. That gray dashed line, that is the fair. We call that the fair value on this model. Sorry about the table. The things got shifted over, so just ignore the table's a bit wonky. But the most important thing I just want to share was the data. So on this model, it's pretty up to date. So it has the price at 72,290 that's what it's based on. So we're a little higher than that now, but it's pretty close. And then the fair value right now on this model is basically 69,000, right? Just below 69,000. So this model shows us at the 52.44 quantile. We're probably a little higher, so maybe around 53 quantile or something like that. So what that means is 53% of the data points are below the am I right on that? What am I saying here? Yeah, 53% of the wait a second. Yeah, 53% of the data points are below and 47% of the data points are above our current price, right? That's I guess a way to say it. But with the fair value, it's 50% of the data points are below and 50% of the data points are above. So that's how you determine that 50th quantile is basically 50% above, 50% below. That's a 69K. So this one's a little bit lower as far as the fair value. It doesn't really weight. It weights things. Weights all the data points a little bit more similar. So the kind of the extremes of the peaks don't pull up the fair value as much as the last one we discussed. But yeah, essentially it shows us at about 5% overvalued, and we're at the 53 quantile, 5% overvalued. So that's the takeaways on this model. But again, 5% is nothing. We'll be way more overvalued in the coming year. So it's just a bit overvalued on this model. But
what about the rest of these? These are today's range of the channel, right?
Yeah, exactly. So this is showing as of today, like this does kind of slowly go up over time throughout the cycle. So the model will increase. But as of right now, if the price was in the range of 190 to 246, so like if we were sitting at 190 to 246, you'd be in that top band, that red band. So that's the 97 to 99.9. So what that means is only 3% of the data points are basically in that range. Like we've only been there 3% of the time. So if you're in a band and you've only been there 3% of the time throughout the history of Bitcoin, relatively speaking, you should be kind of concerned because like we talked about, there's a higher risk of reverting back to the mean is what they call it, or the median in this case, right? So you're reverting back to the median. So it's like an elastic band. The further you get away, the more probability there is it's all probability based, right? So the more probability there is to kind of come back down to earth. So that's the top red band. And then below that, we have the orange one. And so we're not 100% sure, of course, that we're going to get to the red band this cycle. We've kind of discussed the possibility of, maybe we don't get there. But I think there's a really good chance, really high probability, we at least make it to the orange. And so that orange is sitting at right now 145 to 190-ish. And that's the 90 to 97 quantile. So that's basically saying we've only been there 10% of the time, or the top 10% of the data set. So Yeah, anything above 145 as of today would put us in kind of like somewhat of a risky territory to revert to the mean or the median. And then the bottom band. The bottom band is interesting because that's kind of your downside risk on this model. Of course, there's always a probability of going lower, but this bottom band is held really strong throughout the history of Bitcoin. We're pretty confident in that band. We actually think it's connected. That's another chart we can discuss next week maybe, but we're still speculating and still trying to determine, but we do think there could potentially be a relationship between that blue band and the actual production cost of Bitcoin. It's quite interesting when you look at the actual cost of producing a Bitcoin tends to kind of be in that range of that blue band. But so there could be something more there that actually supports the price, because usually commodities, which Bitcoin is a digital commodity, typically speaking, they don't really trade below their production cost. So that's something interesting to note. But right now, that's sitting at 35 to 42K. That's the bottom 5% of the data set. So we're only below that. We're only in that blue. If you're in that blue band, you're kind of it's only 5% of the time we're that undervalued, right? Is a way to say it. So that's pretty much the overview on this one. Yeah.
What are the valuation in 2025? Okay, so I actually did look at this one, but it would be too many charts, so I didn't kind of prepare it. But I can quickly. So
We
while
showed that last week, didn't we? Yeah, you showed that last week. Kind of like what it looks like at
exactly.
the end of wasn't it the top 1% is 285,000?
Yeah, let me just pull it again. All right. Okay. So, yeah, let me just read these to you. By the end of 2025, and my graph doesn't look perfect, so but never mind, I'll just show it. I have to make the background black. Okay, so by the end of 2025, this channel would go from 55K to 285. So the number that Plan C was showing today is kind of around 200,000 for the max and 40,000 for the minimum, right? That's going to grow to 285 and 55. And yeah, so that's how it grows. But maybe since I showed this, we can also talk about this way of looking at it, right? If I break down the probability in 3 pieces, this is where we are right now, and we are kind of in the middle zone, right? But that's what actually slightly overvalued, possibly if you look at the median, slightly undervalued if you look at the average. But nevertheless, we're still in this kind of transition phase. So the way I look at this is we are warming up, right? We're definitely out of the blue zone. So the bear market is definitely over, and we're just warming up to get to the explosive price action in the red zone, right? So, but at the end of 2025, this is what you're looking at. As soon as we passed 136, here we are kind of above this quantile 66 and entering the bubble territory. And this model will basically say the top of that bubble by 2025 should be around this number. And of course, this is all probabilities, right? It can go higher, it can go lower, but the model says the 99th quantile will be at that level. So, and if you look at the prior cycles, we kind of do that as well. We have these super low cool periods, like extreme low valuation in bear markets are also here. But then we go through this transition phase. We tried once here, didn't work out. COVID happened, and then we tried again, spent some time in the transition period. And once you're out of the transition period, the bull markets, the main thing that kind of people know as the bull market, the main exciting price action begins. And then, but that's just the beginning, right? So it doesn't mean, again, you get worried or anything. You just wait it out, and the price goes up. And then, but the quantile model will be able to exactly give you the percentage, the quantile, where we're at. And typically in most prior cycles, once we've been getting closer to 99th, and I would say just above 90th percentile, the peak is very near, like you see here. So here we probably got to 98%, here past 99, here past 99, and this one is slightly, kind of the same number, I would say. And then yeah, so the quantification is very helpful in telling you where we are in the kind of the channel that this model would suggest.
Yeah, the red is kind of like the full bull, right? That's like the full bull market. That's when things start to go a little bit parabolic and they're a little bit less, like things become less sustainable. And then yeah, with those previous peaks, like we got to 99.9 for 2013, 2017, we got to 99.9, and then last cycle we got to 99.5. Now it's only a half a percentage difference on the quantiles, but it's actually quite a bit different in dollar terms. But we spent quite a bit. We talked about this last week. We spent a lot more time though, even though the amplitude wasn't as high. We spent more duration there, so it equals about the same peak. We kind of discussed that last week. How even though the last cycle we didn't quite get as high on the quantile, we spent a longer period there. So it's essentially was the same kind of extreme period, right? So. But yeah, no, I like this model. I like the way you broke it down into three. It makes it really simple to follow. We have kind of like the blues that is the bear market. That's the accumulation. That's like the heavy accumulation period. That's when you really want to be buying, is in that blue zone. That's when you want to be loading up and DCAing as heavy as possible. That's if you can buy as much Bitcoin as possible during the blue, that's really you set yourself up for success throughout the cycle. And then that green is still a decent place to be buying. Especially the lower end of the green. So, but then, yeah, once you get in the red, maybe you want to lighten up on the DCA if you're a longer term holder. Because once you're in the red zone, there's a decent probability will at some point go back below kind of that bottom of the red zone, right? Like the way I would look at it, we don't know for sure, of course, it's all probabilities. But once you're in the red, it is possible that when the bear market comes, we do end up kind of trading below that red period. So it gives you, yeah. So that's another discussion for another day, though. Yeah. What else did you want to add on this one, Sina? This gives a good overview of kind of.
Yeah, just a heads up, if people.
Oh, I think we lost Sina here. Shoot, just a second, guys. We'll figure out what's going on here. I'm not sure if you guys can still hear me. I think I'm still live. It shows us both is still live. I don't have access to the chart, so unfortunately I won't be able to keep talking until he reconnects. So he'll probably reconnect here in a second. Technical issues, bear with us here. Let me just message Sina and see what's going on. Sure. Yeah, I'm not sure. This is first time this has happened before, so we might have to disconnect and reconnect. Interesting. Oh, you're back. Awesome.
Yes. What happened?
I don't
What
know.
happened to me?
It's just disconnected. Hopefully, I think people are still here, but yeah, we can keep going.
All
I
right.
think everything's good. It still shows us both as live, and so yeah, I think we're fine. So what were we talking about? We were talking about. Oh yeah, one you were actually speaking, but I was going to say one thing with that last chart. If you pull it back up, um, and we can move on to the rest of the charts we have. But it really depends on when we peak. That's the other thing, right? You got like the timing factor, right? So the model you were showing with the 285 is the top 1%. That's only at the end of next year, right? So like there is a probability, of course, we can peak middle of next year, right? We can also peak in middle of 2026. I like to be, I think both of us are this way, but I like to be as agnostic as possible when it comes to the price, or when it comes to the timing of things, because we really don't know. Yes, we've had this 4-year cycle, and yes, we typically have peaked in December or November towards the end of the year, but that doesn't mean that's going to be the case again. So we want to kind of be open-minded on when we'll actually peak, and just let the data determine, like follow what the data says. Right? We're going to look at liquidity. We're going to look at sentiment. We're going to look at derivatives. We're going to look at many things as the cycle goes on to determine the timing component. So right now we're just kind of showing this is the end of 2025. This is where we be, but that is dependent quite a bit on when we peak is the point.
Especially that when I'm not in the camp that says, everything is pre-programmed by God and by Satoshi and everything will exactly happen like the last cycle. I actually expect some deviation, right? Having is important, right? Because after having happened, supply goes down. So it's important, but there are now other important factors like what ETFs do, what Wall Street does, what other MicroStrategy emerges. If a nation state announces that they're accumulating Bitcoin, I guarantee we will immediately get into the red zone and and we reach the top a lot faster, right? So the way I think about this is we need a huge catalyst. If there is no other catalyst, halving will do its job because it's every day. It's like a new buyer in the market, right? Just sellers got less powerful. So every day it's basically like some more additional buy pressure. But in my opinion, the explosive part of bull market starts as soon as some catalysts pushes the price high enough to bring in a lot of speculators. And when that happens, this is kind of like uh, you put a spark in a tank of oil, and then it begins a self-reinforcing cycle higher and higher until it exhausts the buy power in the market, and then it kind of comes back down to a more sustainable level. But when this push happens, in my opinion, it's kind of anyone's guess, right? So we can get a sense of it, right? Just generally speaking, it's not going to be 4 years from now. It will happen sometime much sooner. But exactly when this happened, too many things affect this. So I don't think we can really model it exactly after the prior cycles, right? So that's why I'm like, I wait for it to happen, and when it happens, we will know on our model. We will see the valuation, and we don't really need to kind of predict the exact time that this will happen. And most people that try to predict kind of are essentially guessing. There's no reliable way to do that. Yeah. So, but other than this, I will quickly talk about something else before going back to Plan C's 2 new models. The other way to am I still there?
Yeah, you're still here.
Okay.
Yeah.
Yeah. Let me look at the comments. You see, is MSTR actually? That's a wonderful question. Is MSTR under or overvalued? Next week on Best Bitcoin Data Show, we have an MSTR panel. So essentially we have talked to 3 MSTR analysts, which we will come on the show, and hopefully the 3 of us, Plancy and I and Sminson, will also be present to kind of guide the discussion, but they will talk about MSTR. So that definitely be there for that one.
Yeah, and these are 3 of the most well-known MSTR analysts in the space. These are people that have been, we're really in early, and we're kind of pointing to this MSTR trade well before the pack got in. So these guys are really deep on MSTR. So definitely, if you're interested in MSTR, you'll definitely want to tune in next week. That's on the 5th, right? We're doing that basically next Tuesday, I believe, right?
Yes, absolutely. Ryan, Jeff, and Danny. I've asked them to prepare some analysis ahead of time, so this will be fantastic because they'll be just, you know, compressing all their knowledge into a few slides that will give us the gist. So we'll let them speak a little bit about their own viewpoint, and then we'll kind of go from there with our own questions. Okay, but the other thing I want to talk about is MVRV. If you look at the raw MVRV, we are kind of like at sitting below 2, which is pretty good. I mean, the market valuation, essentially the way I read MVRV is how much unrealized gains exist in the market. Right now, the unrealized gain is less than twice. If you look at the 1 to 2 range, it's less than twice the real dollar that has entered the market, and that's amazing, right? You don't want the market cap to be too much higher than the real dollars that entered the market, because that only means the market is thinner and the valuation is frothy, right? So that's great, but we don't know how high is the max in this cycle. As you can see, like, we have been just kind of going down. The maximum has been going down, so we don't know like what is the max to kind of gauge how high this point is, right? That's exactly what we have done in the rest of the slides. We have adjusted MVRV by a metric of volatility. Volatility is going down, as you can see, throughout Bitcoin's history, and then I've created a model that kind of that orange line is a model of volatility reduction. And it's also, by the way, it's interesting that volatility is picking up from a low right now, and that's a great sign of market warming up, right? But if you adjust for this volatility, you get a much better MVRV model, which I call volatility adjusted MVRV, VMVRV. And this is basically always ranges from 0 to 100, and the peaks are kind of in the same range. That gives us a very good gauge to see how high this will go. So right now on this chart, we are at, what is it? We are at kind of 38, 37, and that's still below half. So we have quite a bit of ways upward compared to, you know, the point that has typically marked the top of the cycle. So this is another valuation model that we can think of. So Bitcoin is essentially sitting at 40% valuation if you considered 100% being the historical peak.
Which is interesting because it's very similar to the power law. This is a completely different metric, right? This is on-chain data. This is to do with, like you said, the MVRV, so market value to realized value. So completely separate than the other one you were showing, which was the power law or the volatility adjusted power law metric. But that one, they're both sitting around the same place, which is interesting. So it's confluence, right, between two different metrics.
Exactly.
And but this metric is actually, like, I've looked at on-chain metrics for the last 4 years. I've looked at all the different available on-chain metrics with Glassnode, but this metric is fantastic, Seema. Like, for people don't realize how awesome this metric is. You pioneered this. Like, you created this yourself. I've never seen anyone else post this or create this. And this metric, Glassnode should have on their site. This is way better than MVRV. Like, the one that everyone else is looking at is the use of it compared to this. It's not as good because you can see the consistency of those peaks. And the interesting thing is you can see where we topped out. We got up to about looks like around 72 or 3. It's actually comparable. Looks like we had a. Actually, we got relatively high. Actually, if you look at that, because look at the peak we had after the just before the COVID crash, right? Before we went down for COVID, we had a bit of like kind of a mid-cycle peak there. That one looks like we got only up to around 50 just before that, like that the peak there between the two. Yeah, that one looks like we got up to around 50 on that. So this one was higher on this metric, right? And so and then if you look at, I guess we had roughly a similar peak kind of before the 2017 the 2017 peak. We had a relatively kind of like high peak there, but that was pretty late in the cycle. So, but yeah, this metric's interesting. I don't know if it's like, the only thing about this metric is because of the downtrend at a certain point, it seems like we're going to have to break to the upside on this metric. Like it seems like it's inevitably going to break, but we'll see though. It's held up really well, and it's really useful as of now, right? You can
But some
see
of the things that this might help us is like kind of adjust the basic expectation. Like if you looked at MVRV when a few months before or after the approval of the ETFs, we were at here, right? This is the first 73 mark that we saw. But historically, 2.5 or something, which is this one, right? It's probably this point, right? 2.5 isn't that high, but in fact, if you looked at the adjusted version, you see that's actually quite high, um, because this cycle, well, the max has gone so much lower, right? So 2.5 actually did seem quite a bit like at 75% or something here. That does show quite a bit of heating up of the market, right? So
which would
this
have, yeah, that would have helped to for people to be like, okay, well, we might need to cool off for a while, right? Which is exactly what happened. You can see the last 8 months we went down from just from going sideways for 8 months. We essentially went down from
exactly.
like 70 whatever 3 down to 40 or down to 38. Like it was a significant drop. So yeah, it's a very interesting metric. I really like this one.
Perfect. Okay, so let's move on to the last part of the show. We are jamming so much, so many charts here. I hope it's not too long, but the part that I'm really excited about today is this one. That's something Plan C has recently
Actually,
introduced.
can you start with the other one? Yeah, that one's perfect. Thanks, Sina. Yeah, that was great.
So tell us what this is and what can we learn from it.
Yeah, so this is an on-chain metric. So this is very, like, we've covered power law quite a bit in previous weeks. So we are going to start introducing, because we really like the idea of using, the show's called Best Bitcoin Data. So the whole point of the show, as we've already discussed, is to pull from the best data across multiple categories. So power law for sure, on-chain data for sure, derivatives, liquidity, some TA stuff potentially. So we're looking at even markets, even some sentiment data. So with this, it's one of the better on-chain metrics I've come across. It's all, we don't want to just show any on-chain data, right? We're handpicking the ones that we feel are the signal in the on-chain world. And with this one, it's actually a tier 3 Glassnode metric. So most people don't even have access to this metric. It's quite expensive actually to have this subscription for Glassnode to get this data. It's about 10 grand a year. So most people, they just don't have access to this. So you guys are getting kind of exclusive content here. Now with this specific metric, what I found was when you use a 90-day EMA. So the reason why I use a 90-day EMA is because if you're just using the raw data, you don't have this consistency on the peaks. It doesn't. I'll show it another week, but it's not as useful. When you use the 90-day, it really gives you kind of more of a longer term perspective, and you can really actually compare, relatively speaking, the different peaks and throughout the cycles.
And EMA is the exponential moving average.
Exponential moving average. The reason why I used exponential is because when you use a 90-day SMA, it kind of moves the past the peaks, right? So that actually causes it to drift past the peaks because it's a simple moving average. So when you use the EMA, you're actually pulling the data back a little bit. It's a little hard to explain, but you're essentially lining up the peaks better so you can get more signal. So the 90-day EMA really is the best way to look at this metric through. It's the best lens, and it's the best way to, relatively speaking, compare all the cycles. And I looked at lots of combinations, but this really is the best way to look at this metric. So the thing about this metric is it's quite interesting because it's entity adjusted. So what that means, there's a lot of terminology here. We'll go through it. We'll try to explain it, and Sina can help me. So entity adjusted is really cool because, and again, it's only with the tier 3.
Plan C, why don't you first tell us the content and then why is it?
Sure.
So this is talking about
short-term holders. Yeah. So what we're looking at here specifically is the short-term holders. So the way Glassnode kind of organizes the different holder categories is they break it up into long-term and short-term holders. And so the cutoff point for that is 155 days. Now the way it works is it's the to be specific on it, it's the average. So okay,
So basically, Glassnode did this analysis to show if there's a difference in behavior of holders. And and they realized that if you're someone that holds the coin for 6 months, to be exact, what was it,
155 days, yeah.
155 days, if you already held your coins up to that point, it is they classify you, and actually the data shows this, that you are a long-term thinker, you are a long-term investor, right? Because they will see in the data that people who actually hold that long, they will not sell, they will sell at a much less likelihood compared to others. And there's
Yeah,
this second
yeah.
category that are short-term holders. They're kind of constantly selling and buying.
Yeah, that exactly. That's well explained. Like it's a cutoff in the statistical analysis. It's the cutoff point. It's like a threshold, right? So they found by looking at the data that once you get beyond 155 days, and it's not like it's just at that point. It kind of tails off, below and before and after that date. But that is kind of this most statistical significant point where once you get past 155 days, the probability of someone holding long term increases. Right? They become, like you said, it's like a threshold with a mindset that once you get beyond that, you're more likely to hold longer term. And so it's a significant point. It does differentiate between short and long term holders, people that are maybe more trading versus longer term holding. And it's the average out of all the purchases. It's essentially the average hold time of the coin. So someone can hold, they could have bought coins at multiple points. And some they might have held, 130 days. Other coins they might have held 170 days. But it's the average hold time of that specific entity. When I talk about, first we'll go into short-term holders. So what this metric is looking at is it's looking at the net unrealized, right? So unrealized means it's kind of like the profit or loss that you're sitting on. You're not realized is when you actually sell. If you're realizing a profit or you're realizing a loss, that's when you sell. So if you sell at say $50,000 Bitcoin and you bought it at $40,000 Bitcoin, that's a 10,000 realized profit, right? Because you bought at 40 and you sold at 50. That's 10,000 of realized profit. But if the price is say at 50,000 and you bought at 40, you didn't sell, you're sitting on 10,000 of unrealized profits. So that's the difference between unrealized and realized. Some people might know this, but for the people that don't, that's the distinction. So this is looking at the net. So it's looking at the whole market, all the holders that are in that short-term holder category. It's looking at like it's basically all of them together, right? It's combining them all together. It's aggregating all that data. It's a lot of data being aggregated together and combined, and it's saying what is the net position of the realized and the unrealized profit and loss.
And why is unrealized important? Because if people are sitting on a lot of unrealized profit, it just psychologically makes them more likely to sell, right?
Especially when they're short-term holders, right? So they're
right.
short-term holders, so they're not yet thinking long-term. And if they're sitting on a lot of profits, they're more likely to capitulate, right? Or more likely to sell. Like they're trigger happy. Like it's like they're more, so and it goes in both directions. When they're sitting on a lot of losses, right, they're more likely to capitulate to the downside. So it's kind of shows they're more emotional. It's a more emotional category of holders, more affected by the markets, the price action. So and this is looking at a 90-day EMA. So we're trying to take this data and zoom out a bit and then look at it kind of on a higher perspective. And you can see it's actually been a really good metric to visually see when we've hit the kind of the peaks, at least historically speaking, and gives us a really good reference range of where we're at, right? So it's one lens, but it's been a good one. And so, yeah, anything else you want to add here? So short-term holders we covered. It's the net unrealized profit and loss position of those short-term holders. We're looking at it on a 90-day exponential moving average. And then it's the entity. So there's a lot going on with this metric. And then it's the entity adjusted. So what entity adjusted means is it's going beyond the normal on-chain data. What it is they're actually filtering out wallets. So you can so there's individual wallets is how you can look at the on-chain data through. But when you look at entities, they're actually through the algorithms, Glassnode's able to determine someone might have 10 different wallets, and so they basically say, okay, that's one entity controlling those 10 wallets. And then if there's any transactions going between those wallets that's controlled by that single entity, we're going to filter that out, right? Because that's just noise. That's not signal, right? And so that's the cool thing about the tier 3 Glassstone metrics is any in-house transactions between wallets that are controlled by a single entity, they're removed. And so you're really only getting the significant movements of the coins. And so that's what this is filtering out. And when we look at this metric, and Sina, you feel free to add, anything you want. I circled kind of I basically broke it down into 3 different color circles here. And so what I showed is you can see that top dashed line on the top there. That's kind of showing a point where, historically speaking, once we've gone beyond that, it's been a peak, right? And so we're nowhere near that right now. We're not even close. But you can see how well this is held up. And there's actually really not been much of a downdraft, which is what makes this metric pretty unique. Because a lot of on-chain metrics and TM metrics, there's quite a drop. Like we looked at last with the MVRV, you can see it drifts down. With this one, the first peak we had in 2013 got to 0.38. The second peak in 2013 got to 0.35, I believe. I have to pull it up, but basically they're all fairly similar. Like the last two, I think were 0.34, 0.3. I'll pull it up in a second. So, anyways, the red ones are the peaks. You can see the blue is quite interesting because the blue has been kind of like a false peak, or not a false. The best I kind of called this on the post I did. I said major summit. How did so I said major summit is the red, the blue is a false summit, and then the green is base camp. So that's kind of like an analogy I use with climbing a mountain, right? So you have red is the major summit, false summit is the blue circles, base camp is the green circles, and then I'll just share the major peaks here quick. So 2013, the first top was 0.38, the second top was 0.35, the 2017 top was 0.35 as well, and then the one we had last cycle, the first peak in April 13th of 2021, that was 0.34. So there wasn't really a drop between those peaks much. And then right now we're sitting at 0.02, right? So 0.02 is where we're at right now, and that's the green. And basically that neutral point is base camp, right? And you can see all the times we've been at base camp. So you can kind of look at this metric and you can say, well, where are we relative to the previous peaks, right? Or previous cycles? And you can see we've fully corrected down. Like we've fully come all the way back down. And look at where we were, say in the 20, just after COVID. See that green circle just after COVID? See that one there? That's basically on this metric. That's where we're at. Like, and that was the interesting thing is like we're back because of this 8 months of consolidation that's brought us way back down. This is the first time in the history where we've been at an all-time high while we're at base camp.
Because we are kind of price is going back to where it was after ETF push, but you see how much the market has closed, and this is the magic of 7 months of consolidation. Because a lot of people anyone who wanted to sell has sold, and people aren't really sitting on any significant amount of unrealized gains. So there isn't much incentive to sell at these prices.
All the short-term holders got shaken out of the market. They got shook out of the market, or they just, you know what I mean? Yeah, exactly like you said. They're all these short-term holders, all their I guess they became long-term holders. That's the other thing. Some of them graduated into the long-term category. So they might have been sitting on some gains, the short-term holders, but they held longer than 155 days, and now they're long-term. So now we can say there's a higher probability that they'll hold. And now the shorter-term holders, they're not really sitting on any profits. So they're not really a risk, right? Because like, okay, yeah, they're more likely to sell, but they don't really have profits right now. So
because long-term holders, they're gonna wait it out, but short-term holders, who are the typical people who cause these fluctuations, they don't have much reasons to sell. And if in fact if we go further down in price, they will end up getting into the negative territory, right? If you actually do see them sell at a loss, that's a wonderful place to be. So we don't have any kind of we don't have a major risk from this metric. But there are two questions. One person is asking, M is asking, why use exponential moving average? We kind of touched this on this a little bit. Exponential moving average is slightly different from simple moving average in the sense that it kind of prioritizes the latest data points. It gives them a stronger weight compared to simple. And as Plan C was saying, he has kind of compared a few things, and this performs the best.
Yeah.
The other thing is, so I'll just show this one, and you can answer both of them if you want it. Where can I access this overview? I'm Alexish. I assume you are talking about seeing this chart, which this one is proprietary, right? It's a unique. It's kind of the highest membership you got to have at Glassnode. So, but I'm assuming Plan C will be posting constantly about this, right?
Yeah, I'll be posting it on my account. We'll be covering on the show, and then I'm pretty sure because of the subscription we have with Glassnode, there is the potential to use their APIs and put this on a site. We'll have to determine that, but yeah, this data, there's a possibility we'll be able to post this on a site in the future. But for now, it'll be on my account and on the show is the main places to find it. Go ahead. So was there something else, Sina, you wanted to? Yeah,
we can move on.
Okay, and then just quickly the EMA thing, because I think it's important. So the reason why I chose the EMA is because when you again, if you don't do the 90-day moving average, then it's not as consistent with the peaks. You have more of a downdraft in the metric. So the 90-day really does help to condense the data and zoom out and really see an overview of what the actual signal, right? Because you can look at a metric and there's not really much signal. But when you add moving averages and you do different things, you can really pull out the actual signal in the data set. And that's what I did here. And then the EMA helps to align the peaks, because if you don't use an EMA, with the simple moving average, it causes those, like if you picture that the yellow peak there, if you picture kind of these yellow peaks, if you just picture them moving to the right. So they'll drift to the right. And so you're not going to get the signal because it's past the peaks. When you use an EMA, because it weights the more recent data heavier, it actually pulls back it pulls it back to align with the top. So it allows for more signal. That's essentially how it works. So it's just I've used this with other metrics in the past, and I found with on-chain data, when you're looking at things on a higher time frame, which we're looking at the 4-year cycle or longer. A lot of these on-chain metrics, the signal comes out when you use like 30 and 90-day moving averages, and when you use EMAs, that's just how it. And EMA kind of counterbalances the fact that you're using a higher time frame moving average. So that's how it works.
All right. By the way, we are past 4,500 views on the live. I think that's a record.
Yeah, there's a lot going on right now. There's a lot of people streaming because there's, with the price action. I was looking at my X account. I'm like, wow,
maybe it's the pump that.
There's a ton of people streaming. Like a lot of people are live right now on X. So
right.
a lot of options for shows. But yeah, this is the same data. This is the exact same data as the previous chart. I just visualize it in a different way, right? So it's just looking at it as an oscillator and really just looking at these different zones. And so all of these zones are even in as far as the distance. So they're all 0.4 between them. So the top one is 0.34 to 0.38. So there's a band of 0.04 for each of these. And the middle one is 0.02 and negative 0.02. Right.
Now,
so
two questions. Is this similar data? Exactly.
It's the exact same. It's the exact same data.
And then did you create this graphics, or was it default on Glassnode?
Oh, I made all the, I made this. So what I did is I used Glassnode has a workbench, and so you can customize charts. And so I took the data input, which was the metric before, and then what I did is I added these horizontal lines by just putting in on workbench. You can put in the numbers you want, and it'll draw the line across, and then you can change the colors. And then I basically I shaded in the middle area with another tool. But this is all these lines are exactly where they're supposed to be. So according to the data, right? So the cool thing about this oscillator is it's held up really well for the peaks, but it's also held up extremely well on the bottom. It's actually a usable metric in both directions, and it's actually bottomed out before the bottom. So it actually can be a leading metric to let you know that the bottom's coming. At least in the last cycle it was. The other ones it was pretty good as well. We can look at that when that's relevant. Right now it's not relevant. But you can see where we're at. Like we're essentially finding support on the green band, right? And you can see like in the last cycle, in the last, like we actually broke through green and we went below it during COVID, right? So we bounced off orange just like we did in the previous cycle, right? The previous cycle we kind of hit orange and we kind of found resistance there, and then we went down and broke through the support of green. This time it looks like we're bouncing off green pretty strongly. And this is the second time we've bounced off green, right? And green is base camp in the previous chart, but it looks like we're finding support at green, and it doesn't look like we're going to go below green. The only time we went below green last cycle, but that was because of the black swan of COVID, right? But yeah, relatively speaking, again, like if you look at where we're at, I mean, look at the 2017 cycle, right? Like we're just at the very beginning. If you go back to 2017, we're literally like in the 2017. I mean, we're kind of like right in that area exactly. So that was still a year out from the top. That was still like just at the beginning stages of climbing the mountain.
So what I can learn from this is like the main part of the show is just beginning, and we had kind of a fake, if you will, a fake move before that. And by the way, this is very interesting because remember we said using the VMVRV chart that we show, you could have noticed that in the beginning of the year after ETFs we were a little bit hot. This is the same thing. So again, multiple models that have nothing to do with each other, like these are completely different models, yet they're not using the same equations and so on. They say the same thing. If you had used something like this in the beginning of the year, you would have seen that you're kind of slightly, there's too much unrealized gains in the hands of short-term holders, which wouldn't have been an amazing place to be. But it's very clear there. And now we have kind of cleaned all of that up. It's kind of like we are back to, where is it? Like we are back to before all the excitement that happened after the ETF. So we have kind of washed all that, and we've created a new base for the real move to the top.
Yeah, we're at the exact same point. If you look back, I guess. Yeah, we're actually lower. That's interesting. We're actually, if you look at where we were, like in the 2020 year, right? If you look at that chart, we're actually slightly lower. So this time, what I want to compare is where we were this time in 2020, the same time of the year, like November, right? It's hard to see on the chart because you don't have the months broken down, but we're kind of like, we're actually higher on this metric in 2020, right? We're just above the green. So
yeah, we were sort of here.
Yeah, we're actually because this does feel similar to 2020. I'm sure it feels similar to 2016 as well for the people that were here then. But this feels very similar to 2020. And when I say that, it's because I remember the price action the last 2 months of 2020. We started to kind of move up and break through the all-time high. And then we actually, I think, finished 2020. We got a little overheated pretty quickly because we ended up, I think, finishing the year around 30K. I could be wrong on that, but I think we broke through at the end of 2020 was at 30,000, right? Which the peak was 20K, the prior peak. So we broke through the prior peak. We finished the 2020 year at 30,000, which is 1.5 past the peak, right? So that would be the equivalent of going to 30. That'd be the equivalent of going to 105,000, right? Because the peak of the previous cycle was 70,000, right? So if we were to do what we did in 2020, that would be like finishing this year at 105K. Now, I'm not saying we're going to do that. I'm just kind of comparing the cycles as far as overheatedness, right? So that's how fast things got in 2020. We went from breaking through 20,000 in I think a September or October, around that range, and we finished the year at 30K. Right now we're kind of at the all-time high. we already broke through the previous all-time high of 69,000 from last cycle. That would be like going to 105K by the end of this year. We actually don't want that. That's what a lot of people don't understand. We don't really want Bitcoin to go to 105 by the end of the year. I would actually not want that as a long-term holder, because I want us to move up a bit, maybe by the end of the year we break through 80,000 or something. But we want to consolidate along the way. The more that we have these consolidation periods as we climb up, the better. The longer we'll go, the higher the cycle can go. We want things to extend out, right? We want us to peak late into next year, if not into 2026. So the more we can kind of have these consolidation periods as we move up throughout the cycle, the better. So we don't want to move to 105K tomorrow. That's not a good thing. That would probably mean we would peak early next year, like we did in 2021, right? So, anyways, that's basically it.
And that would mean, we now we have kind of several months ahead of us for consolidation. So if we kind of have a huge rapid jump in price, that will also mean the door of opportunity is close to you, and you'll have to wait another 7-8 months for the price to kind of either consolidate or kind of have a slight crash to make it buyable again. So yeah, like you said, I don't like. I actually like an orderly, slow move up. That's kind of matching the fundamentals much better than a adrenaline driven explosion in price, because at that point I'm just gonna be sitting and watching the market, and that's a little bit frustrating. So
What would
anyway,
be ideal for you? Like, I mean, we obviously, it's not in our control, but what would be kind of like the ideal scenario for the rest of this year? How would you like to see things play out?
what I like,
Yeah, if you could control Bitcoin, how would you control the price action for the rest of the year?
well, unfortunately I'm not getting it, but what I really love to see is something that really scares people, and causes them to lose their faith in the cycle. But this cycle, actually, we have had very few of those. Like, whenever we have a crash, it's not even worth the term crash. It's a very shallow drop. um and for this whole year we've been kind of in the same range, except we got to, like, actually look at this chart.
But wouldn't you say, Sina, that 8 months of consolidation is like, it's equally as painful as these 30-40% drops throughout the cycle? Like, it's a different form of pain,
Yeah,
but
it's a different form. Yeah, it's
instead of like acute pain, it's like an elongated pain.
yeah.
So it's
But look at this. Like, it's been very, very frustrating. Like, this kills people, like, especially short term holders, right? Look at this one. What was it, like 2 years of depression, 2 years of horrible. First of all, it was just drop. Oh, is it end? No, one more. Is it the end? No, one more. Is it the end? No, one more. Is it the end? No. Is it the end? One more. And then we just crashed step by step, and then stayed in that range for quite a while, and then suddenly, boom, it was one factor. In my opinion, the biggest thing that caused this jump was the ETF. And then again, done, right? So nothing, just a slight reduction, and we are just getting out of that range. So actually, apart from this beautiful move here that again caused on or around ETF approval, the rest has been extremely painful. So it's been 3 years of really tough time if you weren't anything other than a long-term holder. But yeah, and this is all great because it rewards people with patience, and that's exactly what we want.
Yeah, and throughout the cycle, like, I guess what you're saying is, you wouldn't mind if we have kind of like a 30% correct, like, because in 2017, I mean, that cycle, there was, I think it was 7 or 8 times where we had like these 30% pullbacks, and I mean, it really does reset things, and that's why I think that's one of the reasons why in 2017 we had such a huge blow off top. I mean, 2017 was quite a phenomenal cycle where we just it's on a lot of these power law metrics, 2017 was actually the highest quantile we ever reached. And that top, because it had those seven or eight times or whatever it was, where we flushed out like 30% drop, where a lot of people panic sold, right? And that allowed things to reset, and that allowed us to go extremely high in that cycle. So yeah, we'll see what happens this cycle. I mean, the market is different. Are we going to get these extreme corrections throughout the cycle, or are we going to is the pattern going to be similar to what we've experienced over the last 8 months? Are we going to have these like 3-4 month consolidation periods? Maybe we'll have a couple of those. Like it's really going to be interesting to see how it plays out. I definitely wouldn't mind seeing these moves up and then these 2 or 3 months or 4 months of consolidating. I mean, that could really cause us to extend the cycle, and even potentially go into 2026, which would be the ideal scenario if you want to have the highest prices reached. Because this is, like I said, the chart we just showed, and we're going to wrap up the show here, I think. But the chart we just showed, we're going to revisit that. But the fact that we're the first time ever at an all-time high, while we're only at base camp, while we're actually at that green zone, to me, it's a really healthy cycle so far, and it gives us a high potential to. We built a very strong base. Like this last 8 months has been phenomenal for the cycle, and it's really put us in a position where, yeah, we could end up achieving some of these higher quantiles potentially. We'll see how it plays out though.
Awesome. So I'm just
any questions, I guess, before we close? Anyone have any questions?
Guys, please send us your questions. Otherwise, we are ready to wrap it up. It's been a fantastic day. We breached 5,000 viewers for the first time. That's amazing. Thank you for being with us. Your reaction is what helps us kind of get the feedback. Hey, this is what audience wants, so we'll do more of it. So we definitely need your energy and support there. Anything? Let me check the comments. How often will you up? Okay, let's see. So actually quite a bit. Super. Yeah. So Paul makes a good point. I showed this earlier. ETFs might be the reason we are not getting huge crashes, because it just brought the whole Wall Street to add to the dip buyers, right? There's a lot of financial resources that they have, and they are much more disciplined than the average prior crypto holder. So essentially you're getting a lot of long-term holder mentality injected through the ETFs, unlike many other analysts like Jim Bianco that says all these ETF holders are degens. I actually think on average they are much better than the average crypto holder that we've seen before. Yeah, so then what do we have? Like BTC in euro terms just broke ATH. Okay, in euro we just broke ATH. Nice. How often will you update this chart plan? C? Perhaps
I think at least weekly, probably throughout the cycle. I mean, I'll probably post it once a week on my account. We can quickly look at it on the show. A lot of these models, like once we accumulate a lot of models, we're going to really go through them quickly, because the audience will start to become more aware of them. So we're not going to go into detail on it every week. We'll probably just flash on the screen and say, okay, guys, here's where we are at. We'll give updates. Like the goal is to have 10 plus models that we just revisit very briefly each week. Yeah. And give our quick take.
We're building the pieces of the puzzle, like all the stuff that we showed you guys today, right? For instance, like these models, or these are like the things that we've been building as we were working on the show, right? So little by little we are adding more, and every week we're gonna we will revisit them in a series according to what makes sense at the time, right? So you can just follow us to get updates, and also let us know if there's something that we've forgotten to cover in a while. Definitely let us know. Glassnode, it seems a little bit pricey, but I mean, we'll do our best to bring some of the important charts from there. And another thing, when you buy subscription at those places, is like they give you like 400 charts. And one of the things we're trying to do on this show is kind of point you to the important ones, because a lot of them, as we discussed in the very first episode, is a lot of these charts kind of say the same thing, and they're derivatives of one another, or derivatives of price, which makes them essentially useless, but some are very, very important. How do you tell the difference? You just have to understand what exactly goes into that chart and also back test it on the data and so on, which is exactly what we're trying to. Santa Barbara University, miss you on Twitter. Thanks for the comment. Rom says thank you. Very good. Futures ETF option also create institutional. Yes, absolutely. Kevin is, I believe, right. They absorb volatility. They make the market deeper, right? They make more liquidity. All of that is really important. And especially if you notice this chart, this is one of the reasons volatility is going down. The market is just maturing and getting more reliable.
And I think that's why your volatility adjusts. Like your concept of adjusting for volatility is an extremely good way to go about things, and why I think the power law adjuster for volatility and your MVRV adjuster for volatility make complete sense. This whole idea of volatility going down, I mean, that's just the pattern. Like there's logic behind it, right? Because of institutions coming in, this is how markets mature. This is the pattern that happens in all markets. And so it just makes complete sense. And so that's where, yeah, I think you've pioneered this whole volatility adjusted concept. I haven't seen anyone else do this in the space. And I think it's allowed these metrics, the signal to really come out of some of these metrics, where other people are kind of looking at these metrics and they're like, well, how do I know when the peak is? We're kind of down drifting every cycle, but yeah.
Yeah. The other question is, do you have any of these charts indicators somewhere we can see? We really want to put these charts on a platform. We're just too busy with other things that we're doing at 21st Capital. We just launched our custody solution. You can check our website to look at it. In one sentence, this is the best custody solution available that gives you a backup, right? You can lose everything you have and there's still a backup. So we kind of prioritize that, but right after we are kind of a little bit relieved with that one, we will begin working on some kind of a platform. It might be a website, or it might be a separate website, or the same one, that we will put all these analyses by Plan C and Sminston and I, plus other charts that we like on there, so you'd be able to easily see them. It's just a matter of limited time and attention.
Yeah, we want to have these charts so they're updating like every 10. There is the possibility of having it so like you can be looking at these charts and they're updating every 10 minutes with the eGlassnode API. So it's quite cool what the potential of what we can do, and we're just trying to get it rolled out. The thing is, it's like you said, we're so busy with so many things, and yeah, that custody solution is really cool. For the people that haven't seen that video that came out, I posted it on my account as well. I watched it myself, and it's very interesting because it's self custody, right? We're talking about self custody here. It's a self custody. I mean, these are the kind of solutions that the space needs in order to mature and have more people comfortable holding their own keys, right? So it's a pretty cool solution, in my opinion.
Exactly. It's like you hold your keys, but you have a guardian angel with no trust in us, because it's all baked on the blockchain. So you could even have your guardian angel or backup not be us, someone else you like, or even another setup that you just keep at a much safer place. I truly think this is the next big thing in custody, and we really appreciate the feedback we've gotten on that one. But yeah, so again, as soon as we get some more resources, we will focus on building our own platform. So tune in for that. And again, just the fact that several people are asking it every time we talk about it, a lot of people ask it, is a great feedback for us to do that as soon as possible. So thanks a lot, guys. Thank you very much for the feedback and the comments, and being with us. 5,200 people. It's just amazing that you can go online with a click of a button and so many people listen to your content. With that, I want to close it. We missed Sminston. He's traveling, but he will join us next week with his great content. And I want to appreciate Plan C for his fantastic contribution and analyses and charts as well.
Yeah, we'll see you guys back here next week. And then next week, to remind everyone, we're going to be doing the MSTR content. So we'll be going really in depth. We actually talked about MSTR a little bit on a previous show, and the feedback was really good. And we're not experts on it, but we gave our opinions, and it was well received. And we're going to bring on some guys to allow us to really go in depth on it. And for anyone that has not subscribed on YouTube, if you're watching this on X, if you want to make sure you're not missing any of the shows, because sometimes you might miss it on X. Basically, you can go to Wilsina can tell you it's 2020. If you I just type in Bitcoin 21st Capital on YouTube, you search that, and then you just subscribe to the channel. It's pretty easy to find if you put in Bitcoin 21st Capital.
Yeah, and it's typically live streamed through Plan C's Twitter and mine. So we just try to meet people wherever they are. But yeah, so with that, thanks a lot, everyone. We went a little bit over, quite a bit over 1 hour, but I hope you liked the show today, and we will see you with a fire session next week on MSTR.
All right, guys, have a great week. We'll see you next week.